Have you noticed how nowadays there's a sense of nervous excitement whenever someone mentions the stock market? Friends, family, financial influencers, everyone's got an opinion, a theory, or a prediction. It's as if we're all waiting for the next big chapter to unfold, and the tension is almost palpable. But here's the reality. The American stock market is making headlines for a reason. Numbers are extreme, records keep being broken, and the experts we trust, people like Warren Buffett and Ray Dalio, are sending out very clear warnings. The big question is, are we on the verge of another historic bubble burst? To really understand what's at stake, let's take a step back and think about the lessons from the past. Imagine Wall Street in the late 1990s. Technology stocks were booming, everyday people were getting rich overnight, and optimism was through the roof. But beneath the surface, legends like Warren Buffett saw signs that most ignored. Instead of getting swept up by the euphoria, Buffett famously held back, staying in cash, while others took on more and more risk. When the bubble finally burst, the stories of overnight losses became just as common as those of overnight riches. And Buffett, he was ready to buy great businesses at bargain prices, turning crisis into opportunity. This is why today, the Buffett indicator is once again on everyone's radar. For those new to this concept, it's simple but powerful. Compare the total value of all US stocks to the country's gross domestic product. Historically, when this ratio exceeds 100%, it's a red flag. Right now, it's not just above 100%, it's well over 200%. That means the stock market is worth more than twice what the entire US economy produces in a year. When this has happened before, think 2000, 2008, the outcome was not pretty. This isn't just theory, it's a pattern that repeats whenever greed overtakes caution. Let's bring in Ray Dalio, the founder of Bridgewater Associates and another giant in the world of finance. Dalio has spent his career studying cycles, how markets boom and bust, how people get caught in waves of optimism and fear. In his best-selling book, Principles for Navigating Big Debt Crises, Dalio emphasizes that the most dangerous periods in the market are when people believe the good times will never end. During these times, risk gets ignored, prices soar, and the seeds of the next crisis are quietly sown. Today, Dalio is sounding alarms similar to those of Buffett. In recent interviews and writings, he points to record debt levels, government deficits, geopolitical instability, and a generation of investors who have never experienced a real bear market. He warns that when everybody is thinking the same thing, most likely it's not going to happen. That's the nature of bubbles, they grow in silence, and when they pop, few are truly prepared. Now let's talk about the CAPE ratio, the cyclically adjusted price-to-earnings ratio, or Shiller CAPE, created by Nobel laureate Robert Shiller. If the Buffett indicator is the warning light, the CAPE is the speedometer. It measures how expensive stocks are relative to average earnings over a 10-year period. High CAPE readings signal that stocks are overpriced relative to their long-term profitability. As of now, the CAPE is well above historical averages, at levels seen only before major crashes like 1929 and 2000. It's not just numbers and history, though. Let's look at what's happening in real time. In the past year, we've seen wild swings in tech stocks, speculative manias around new sectors, and an explosion of get-rich-quick schemes on social media. Young investors are entering the market in record numbers, sometimes risking everything on a single trend or meme stock. At the same time, experienced investors are quietly hedging, diversifying, and holding cash. The contrast is stark and reminiscent of past bubbles. But what does this all mean for you? Should you panic and sell everything? Absolutely not. The point here isn't fear, it's preparation. Buffett himself has always said, opportunities come infrequently. When it rains gold, put out the bucket, not the thimble. The smartest investors don't run from volatility, they prepare for it. They understand that the market moves in cycles and that every bubble eventually bursts. But after every crash, there are always new chances for those who remain calm and informed. Let's dig deeper into how major players are reacting. Hedge funds are increasing their allocations to safe haven assets like gold, government bonds, and even foreign markets less affected by US speculation. Companies with strong balance sheets, proven profits, and global reach are being favored over flashy, untested newcomers. The biggest mistake, say the pros, is betting everything on continued good news. Ray Dalio's all-weather portfolio is a classic example of how to think long-term and stay resilient through any market. His strategy isn't about picking the next big winner. It's about balance, stocks, bonds, gold, and cash, all in proportions that minimize risk no matter what the market throws at you. This is how some of the world's richest families and institutions invest, and it's a lesson every individual investor can apply. It's also important to recognize how psychology shapes markets. During the 2008 financial crisis, panic took over. People sold in fear, often at the worst possible moment. But those who followed Buffett's principle of being greedy when others are fearful picked up blue-chip stocks at historic lows. Fast forward to the recovery, and those disciplined investors were rewarded handsomely. Let's not forget international examples either. In Japan, the stock market hit astronomical heights in the late 1980s, only to collapse and take decades to recover. The lesson: markets can stay irrational longer than most think, but fundamentals always win in the end. Investors who diversified globally, who avoided overconcentration in a single market or sector, fared much better. So what can you do right now? Practically speaking, review your portfolio. Are you too concentrated in hot sectors or speculative assets? Make sure you have cash reserves, not only for emergencies, but to take advantage of future opportunities. Diversify, not just across sectors, but geographically. Consider exposure to assets that behave differently in crises, like gold or government bonds. Stay disciplined. Set your investment rules and stick to them, even when social media and the news tempt you to act impulsively. Another point: beware of herd mentality. History is full of moments when everyone thought the party would never end, from the roaring 20s to the dot-com bubble and even the real estate frenzy before 2008. When you hear phrases like, "This time is different," be extra cautious. Markets have a way of humbling even the most confident predictions. Let's hear from you. What's your personal experience with market cycles? Have you ever been caught in a bubble, or did you see warning signs and change course just in time? Share your story in the comments. The more perspectives we have, the smarter and more prepared our community becomes. Now, let's look at possible scenarios for the coming months. 1. The optimistic scenario. Markets keep rising on the back of innovation, economic stimulus, and investor confidence. The bubble, if it exists, keeps inflating until a trigger event pops it, often suddenly. 2. The gradual correction. Investors gradually become more cautious. Valuations start to normalize, and instead of a violent crash, the market corrects through a slow decline. 3. The shock event. An external catalyst, a geopolitical crisis, major company bankruptcy, or unexpected rate hike, leads to rapid, widespread panic and a sharp market drop. Each scenario requires a different response, but the key is preparation. No one can predict exactly when or how a bubble will burst, but everyone can choose to be ready. Before we wrap up, let's talk about mindset. The greatest investors don't win by being the smartest in the room. They win by being the calmest. They don't chase hype or run from bad news. They adapt, learn, and keep perspective. As Warren Buffett said, the stock market is a device for transferring money from the impatient to the patient. Patience and discipline, these are your best assets. In closing, remember, stay informed, stay diversified, stay disciplined. Don't let fear or greed dictate your decisions. If you found value in this video, help us grow this channel. Leave your like, subscribe, activate notifications, and join the conversation below. Your participation builds a stronger, smarter community. And don't forget, whatever happens in the markets, knowledge is your greatest asset. Here at Grow Financially, we're committed to bringing you real stories, honest analysis, and practical strategies for every phase of your journey. Stick with us, because together we're ready for whatever comes next.